Good evening, friends. Welcome to the 66th session of Analytics Wednesday. We at Sama have been fortunate to have a galaxy of speakers addressing all of us through this Analytics Wednesday program. And today we have got Kamlesh Khanchandani with us. Sama Audit as a company, you're all familiar with. We are in the space of audit solutions for internal auditors, for external auditors through the working papers offering that we have since April 21. And we seek to work with auditors. Our effort is at providing solutions and to see that the investments are fruitful. And for that, we have got various forums through which we seek to do that. There are Google groups. We are just a phone call away from anybody requiring help. We've got e-learning programs. And all of that is being shared with everybody all the time. This particular series has been supported by the Government of Canada Trade Commissioner Service. And we are fortunate to have the association working with us in terms of offering this particular series as such. Let me introduce Kamlesh to you all. Kamlesh is basically a chartered accountant. He is a senior vice president and head of internal audit at ManipalCigna Health Insurance Co Limited. He's got over 23 years of experience in internal audit and risk management, which includes over 14 years in the insurance sector. Prior to joining ManipalCigna, Kamlesh has worked in Aegon Life Insurance for approximately 11 years, which includes 2.5 years where he headed project management. So he's seen the other side of business too, and he's not only been an advisor all the time. His areas of expertise includes risk-based internal audits, IFC, enterprise risk management, fraud investigation, and project management. His prior work includes SBI Funds Management, Jet Airways, ICICI Prudential Life Insurance, and KPMG, where he's done varied kind of assignments for the financial service sector and one of the largest FMCG companies. Friends, Kamlesh, what I understand, is an adventurer. He is not one to be restricted to be behind a desk only. He's done a lot of treks. He's climbed several peaks, the tallest being a 20,001. So he's here to share all his experiences of all these years, risk management, not just from a business point of view, but in general. And I'm sure that we will all benefit out of the ideas that he has to share with us today. With that brief introduction, may I request Kamlesh to take over and share his thoughts with us today. Thank you.
Thank you, Manish. Thank you for the kind introduction. Also, I would like to thank Jairam for approaching me for this. It's an honor to be on this platform. I've seen some of the past videos and I've seen the kind of insights and knowledge that our peers from the other industries have shared. It's very valuable. I must also admit there are a lot of things that I've learned from those sessions. Something that you may learn on your own by doing a lot of experimentation, but these kind of videos help a lot. It's like, why unnecessarily reinvent the wheel when somebody has already done the work? Why not learn from there? So it's a very useful program, and kudos to you and Jairam for keeping up with it, and also having a platform like YouTube where you keep all the videos and share it with the group from time to time. So thank you very much for that. Without much ado, now I'll like to move on with the presentation. Let me just put it on. Is it visible, Manish?
Yes, it's visible, Kamlesh. You may want to get into the slideshow.
Trying that, I don't know why it is going into.
You can just swap the screen over there, Yeah. You've got this next one, right? No, you've got the icon next to it.
This one, right?
No. As you get into the slideshow, there's the half cut icon which is there next to the three dots, right?
Yeah.
Yeah. So there's this half cut icon next to it, left on the left. Here. No. The second one, just after the magnifying glass and between the three dots. If you can
This
just
one.
click on that, yeah. Click again, please. Okay.
No, it's going complete blank.
Now, display settings. No, that's about the settings. I think that's fine. Everyone is on a smaller screen, so that should not be a problem.
Yeah, I hope it's visible because if somebody is on mobile, it will be very difficult.
Yeah, that's
Now, okay. I had to just hide the presenter rule. Okay. So before we begin, I'll just kind of summarize and tell you what exactly am I going to cover. So basically, my slides have three sections to it. First section basically I'll try and cover what basically is the background to data analytics, what data analytics is all about. It will be a very brief, but it will still take about 10 to 12 minutes. Then couple of slides on what we do in internal audit pertaining to data analytics. This is purely only for the internal audit planning purposes. Third section will basically cover some of the few case studies that me and my team have worked on in the past few years and across various functions. So I've just tried to put together some of our work that we have done in which we have used data analytics quite extensively. And I've just tried to put together some of that in the slides in the third section. So let me first begin with the first section, wherein I'll first talk about what exactly is data analytics. So first, beginning with what exactly is data analytics. Data analytics is nothing but looking at raw data, processing that raw data, and making some sort of sense, getting some sense out of that raw data, which can be then used for some sort of business decision purposes. Now, when I say business decisions, from an internal audit perspective, I mean that looking at that raw data, processing it with some objective in mind to kind of derive the exceptions that we are looking at it. Now, these exceptions could be in the form of some outliers, or the other part of that is to also look at assurance from this data that process is working fine. So it covers both the aspects. Data analysis will help us put together the data into more meaningful way for us to be able to analyze and take decisions on data in terms of whether we want to do some sort of further investigations on that, or whether the data, the outcome that we are getting from that data is telling us that things are working fine. So that, in a sense, in a nutshell, from the internal audit perspective, is what data analysis is all about. Now, in the further slides, basically, I'll be covering and giving more details about each aspect of data analysis for better understanding. So this is one of the examples of what data analysis, where we start and where we go. So what you see on the left side screen is basically raw data. I'm sure all of us have seen from time to time the system output that we generate from various applications from time to time for various audits. Usually we get something, what you see on the left-hand side of the screen under the raw data tab. That's how raw data comes to us. Now, if one were to look at that data the way it is there in the current state, it's very difficult for us to make any sense out of it, because it's just like lines and lines of hundreds and thousands of lines of information without any of that information making any sense. It just tells you information about those. In my from my perspective, from my company perspective, this is the information of all the policies that we have issued. Now, the moment you process that data, do some sort of analysis on that, in a way, business intelligence, which is what is highlighted in the tab there, what we see is that meaningful presentation of that same raw data from the purpose of the objective that we had set out initially. What are the exceptions? What are the level of assurances that we are looking at? So the first screen that you see on the top image that you see, there's nothing highlighted. Everything is in normal color. Basically, it tells me that things are working fine. I'm not seeing any exceptions there from an audit perspective. In the second image that you see on the right-hand side, you see some sort of rows being highlighted in yellow. So basically, basis our understanding of the process, we felt that there are certain exceptions and this needs some second level of analysis to see what exactly is happening there, because these were not falling exactly in the way the process was supposed to run. Moving on. So this now will explain how we arrived from that raw data, what you saw in the previous slide, to the business intelligence that you saw in the previous slide. So first step to processing of raw data and making meaningful analysis out of that data is to define an objective. Basically, what is it that we are trying to do when we are doing that data analysis on a particular set of data? To give you an example for us to better relate, I'll pick up a case of claims, because that is something which I'm pretty sure most of the people from an insurance company's perspective will understand. So if I were to do a claims data, I will look at the entire claims that have been logged in into my company for the entire audit period. Now, if I look at that data has almost all the fields, all necessary information that is supposed to come, right from the policy number, when the policy was logged in, when the policy was issued, when did the claim come, what were the health related reasons that the person had to get hospitalized for, what was the claimed amount, so on and so forth. There's tons of information that is available. But if I were to look at that data with a certain objective, it will give me more meaningful insights into the data that I'm looking at. So while that raw data gives me entire information, it does not explain if there are any exceptions to that particular information. To give you one example, if I were to look at if there are cases where there are people who have made early claims, or customers have made early claims, there is a reason why early claims are investigated. There is an understanding that if there are early claims, possibly there is some sort of maybe a non-disclosure, because how often do you come across cases that a person actually buys a policy and within 30 days he needs hospitalization? So it's just a trigger. So looking at the raw data, if as an auditor I'm looking at that data and my objective is to basically see, are there any early claims? What I would actually do is look at the data and filter out that data where I see that the date of issuance of policy and the date of hospitalization is within 30 days. That's the objective. That is defining the objective. I want to see early claims. So first step to that is collecting data. When I collect data, I do not put any filter to collecting the data. I ask for the entire data. Now comes cleaning the data. So once I've collected the entire data, something which is not explicitly mentioned over here, but when I collect the data, I do initially do some sort of a sanitation check on that to see to it that what data I've asked for, I've got that data. It's called basic validation checks to basically see that you're working on the right set of data. It should not happen that, the information that has come to you is partial or not correct. So do some sort of hygiene check on that. Now, after you got the data, clean the data. What I mean by clean the data, like as I mentioned before, when I get the information from the application, there's tons of information that I get. Now, first job is basically, depending on the objective, try and clean the data to see that the final set of data on which you're going to be performing analysis should have the kind of information that you need. In other words, remove the rest of the information which probably is of no use to that particular objective that you want to serve. Reason being, a lot of these files that come to us are extremely heavy on the file size. If I talk about my claims file, I can tell you each of the file size, if I take, would be not less than 100 MB or 150 MB in Excel. So if I were to process that data, first step is basically I should clean and only keep that data that is important for me to identify how many cases are there like these. And then of course I can add other data which I want once I find the exceptions there. That is the part that I was talking about when I talk about cleaning data. Once that step has been performed, we move on to analyze data. Analyze data is nothing but basically basis the objective that we have defined. We start looking at the data with that lens, looking at early claims. There could be other objectives, like for example, if I were to see whether we have settled claims on time or not. There is a regulatory limit on the number of days within which the claims have to be settled. So if I were to analyze that data, that is the objective with which I will collect clean data, keep it ready and analyze. So basically I will look at when was a claim intimated to me, when was a claim settled and paid to the customer. That's the data I will look at. So that is the part of the analysis. Interpretation, application is the last stage, where basically now that I have analyzed that there are outliers, there are cases where there is a delay, I will probably need an additional digging into that to identify what exactly has gone wrong. That comes later. But first part is basically looking at the data, the exceptions that have come out, and applying some sort of logic on that. That logic application will further depend on what do I want to do with that outlier or the exceptions that I've identified during this stage. So moving on, these are the type of data analysis that we do. Why this is important? Because this determines what exactly is the depth that you will be performing when you are going to do data analysis. First basically type of analysis is descriptive. Descriptive, as I've mentioned there in the presentation, it says what has happened. So basically looking, considering the example that I gave of claims, if I were to do a descriptive analysis, I will only look at what happened at that point in time. Basically speaking, if I were to look at the claims data for early claims, I will only identify that there are 100 cases of early claims which have been filed during a particular audit period. That's it. That is what the descriptive analysis will tell me. Moving on to predictive analysis, we will also get into finding out why did this happen. Now, why will, in my case, when it comes to insurance companies, it will require some sort of investigation. That is what needs to be done. However, in my case, some of these activities will be handled offline, because a lot of these early claims, as you know, as it is obvious that people claiming early is not something that I can identify basis data. Here, investigation needs to be done to identify if these are genuine cases of early claims, or was it that there are cases of some sort of pre-existing conditions which people had, but they did not, either deliberately or otherwise, did not disclose. So that is something which I cannot identify from the data. For that, I need to look at reports to see whether there is an investigation being carried out for these kind of cases, and basis that proper decision has been taken. So that answers my why. Moving on to the third point, diagnostic. I also want to, maybe as an auditor, want to look at that, is it possible that something like this may still happen? Now, in our line of work, in case of health insurance, early claims is not an exception. There are times, from time to time, there are cases of early claims. People buy policies and there are claims which happen. Whether this is likely to happen? Yes, it is likely to happen. So as an auditor in this particular example, I have nothing to say, because this is not something, this is more a business risk where I will only look at from a process control whether the function has kept appropriate controls to identify these kind of cases on time, and whether there is a proper process control to trigger an action like investigation in these early claim cases. Last, prescriptive. When I say prescriptive, basically what is the best course of action? Now, best course of action requires some element of assumptions that we do. For example, if I were a business user, now I'm not talking as an auditor right now because of the example that I picked up earlier, but if I were a business user, is there something that as a business user I can put some sort of a control under prescriptive as a part of my prescriptive analysis to say that if I have similar kind of cases going forward, maybe my experience is that there are certain age band of customers, or there are certain PIN codes. This is the analysis that we have done in the first 3 steps. There are some type of, say locations or geographies or some sort of hospitals where I know there is a very less probability of any fraud coming out. Probably the business may take a call that going forward, if the claims come from these kind of hospitals, A-listed hospitals, probably we will not trigger an investigation. It could be, it will not only save cost and time, but it also saves a lot of effort, because our past experience, the business side of the experience is that the investigations in the past have never revealed any sort of wrongdoing because there is tight control in the hospital side. I'm just giving an example. It could be something else. So prescriptive, like I mentioned, prescriptive analysis requires some sort of assumptions. Decisions are taken basis that assumption. Now, in our line of work, even in case of audit, we all know that these assumptions that we make are not like one-time assumptions that we have done and it remains forever. These assumptions under the present business conditions, even for auditors, are always open for challenge every once in a while. Even under audit, when we do, like for example, claims we do twice a year, based on what experience we have had during our first time, the first half-yearly audit, it's not that in the second half-yearly audit we skip those. Yes, our extent of checking may get a little less or more depending on what issues we have found over the last couple of years when we have done audit. But that's the assumption that I'm talking about when we look at the prescriptive kind of analysis. Moving on, there are certain advantages, disadvantages like I mentioned over here. It aids in better decision making. It helps once you analyze, you know where to focus on. The outliers are right in front of us, so we know where to focus more on. It helps taking those decisions in a better way instead of looking at line by line. It increases efficiency of work. Since you're not focusing on the entire population, you're focusing on select outliers. Instead of looking at 100,000 line items, even if you're looking at 100 line items or 200 line items, it is still manageable for us to do it. Of course, on those 100 and 200, you may need to dig deeper into say 50 or 100 or 200 more, but still it gives you far better satisfaction in terms of quality of assurance. Third advantage, improves business understanding, because since you're looking at the entire data, you know out of the entire, once you look at the data, you understand that what is the percentage of population that is falling within the normal process and what is the percentage of population which has exceptions. Within those exceptions, how those exceptions are dealt with, it gives you a great bird's eye view of how the function is being running. Of course, in terms of operationally how the function is being run, that you can understand once you get into the process walkthroughs and execution part of it. But doing this analysis also gives a good bird's eye view of what's happening within that department in terms of volume, quality, channel-wise bifurcation. So if I were to look at my own claims data, I know, for example, what is the share of business from the direct channel that is coming, what is the share of claims that is coming from the manual selling from the agency or the third party that we are doing, what are the number of claims that are coming from group business, what are the kind of claims that are coming more. So it gives a good snapshot of what exactly is happening at the business level. Helps in personalization. Basically, you look at the data, you set out those objectives, you focus on those objectives. End of the day, you identify which are the areas you want to get into and you dig deeper into that instead of generally hovering around the entire data without any focus into or without any know-how into what exactly are you looking at. So it helps you personalize your audit work to that extent. Improves quality of work. As I mentioned before, you exactly know what the outliers are. Instead of focusing on the entire population, you focus on that. The quality of assurance or the quality of work that we do gives us far better assurance because we know that we have looked into that exception part of the work in far more detail as compared to what we would have seen had we gone line by line or just by looking at some random sample without any data analysis. So having covered these advantages, there are some I would say limitations. I won't say these are disadvantages, these are limitations. As long as we are aware about these limitations when we are doing our work, we can take care of these limitations to some extent. So like I said, please be careful. These are limitations. These are not disadvantages. With proper care, these limitations can be overcome and a far greater level of assurance and quality can be derived. So first concern basically is lack of alignment. When I say lack of alignment, basically what I'm talking about lack of alignment is that when you, for example, when the data is being taken, is there an alignment? Is there a proper understanding in terms of what data you have asked for and what data is actually being downloaded and shared with you? I often, and I've seen this happening even with us over here, that we ask for some data and the information that comes to us either is partial, incomplete, or does not meet the purpose. Reasons could be many, and we'll cover in some of the slides when we talk. But this is one very important thing that we should be very careful when we are doing data analysis. Ensure that there is alignment between the team that is asking, which is your team, vis-a-vis the process owners or the IT team, whoever you are interacting with. We'll discuss, definitely I'll come back to that a little later. Second is lack of commitment and patience. Basically, it is more a management limitation, I would say. Investing into data analysis tools, resources has a lot of cost, and it also requires a lot of patience because the benefits don't come overnight. These benefits come with regular implementation of the data analysis over various business functions from time to time. It cannot be implemented all in one go everywhere. So it requires a lot of time, and patience and commitment from the top management in terms of implementation to see the benefits. Third limitation is cost. As I mentioned, cost is huge. Resources, application, hardware, software. With resources, another risk in terms of skills and also in terms of attrition. A lot of people, whenever there's a churn, it's like, 2 steps forward, one step behind. It often happens in at least companies which are in startup where these activities are new. Once this function has been set up, then there is a little less of challenge because the process has been set. But till the time the process has been set properly, this becomes a major issue. Poor quality of data. To some extent, what I mentioned during the first point, lack of alignment. Lack of alignment is more in terms of setting the context properly. Poor quality is basically you get incomplete data, wrong information, data is incomplete. That also comes here. So one must ensure, like I mentioned in the somewhere before also, once you get the data, when you're doing cleaning, before you do the cleaning, do some sort of validation check. See to it that this data, when cross-checked with some other information, some other systems, like for example, when I look at claims data, which comes from the claims management system, first thing we do is cross-check it with the public disclosures that we have done to see whether the numbers are matching. The total value of claims that we have paid is matching. The total count of claims that we have reported are matching or not. It's very important. Otherwise, you are starting on a base which is incomplete. The data is not correct. Second, also look at basically hygiene, like you don't have empty rows and columns, and whatever key information that you're looking at is present in that data. Privacy concerns, again, there is a lot of times we ask for data. Some of that information is confidential, so there are some privacy concerns around that. Once the concerns around privacy are addressed, data analysis can give you a good outcome. Like for example, if you're doing some sort of data analysis on mobile numbers, one such example I'm going to cover in my slides later on. For example, if I were to look at if there are any cases where agent commissions are being paid where the mobile number of the agent and the employee is common. So I need a mobile number. Now, with mobile number, there are privacy concerns. So as long as those concerns are handled, it will give a lot of value when you do these kind of checks. Complexity and bias, basically, data is complex. It's not easy. Understanding in English the data that we need and communicating that in IT perspective to the IT teams. And they corresponding it with the data tables, the way the data has been configured in the systems, that requires effort. That is a complexity I'm talking about. So some effort is required there to overcome the limitations pertaining to complexity. Bias is more with a reference to how the analysis are being performed. So if there is a bias of looking at certain exceptions, probably chances are that we'll invest a lot of time into looking at exceptions from our lenses, which may or may not be correct. So have a clarity on these, and these limitations can easily be overcome. Moving on, this is just a broad snapshot of all the functions where, today data analysis is present. This is just an indicative list. I can assure you data analysis is present in all the teams. I can tell you all my functions in the company here. Everybody performs some of the data analysis in some other way. So basically it is required for target setting, business planning, product designing, pricing, looking at ROIs, customer segmentation, monitoring efficiency, productivity, underwriting, monitoring of claims, marketing, enhancing customer experience, improving persistency, optimal reserving, expense monitoring, and many such functions. So this is just a snapshot across all the functions throughout the company. Now moving specifically to, so with this, I end the first session. Moving on to the second very brief session on internal audit, basically what advantages does internal audit have when we look at data analysis? It basically gives us better risk management. What I mean by better risk management is basically, instead of generally looking at the entire data, you focus on high risk areas. You have your objective very clear in terms of what exactly do you want to look into. Focus on that. With that focus, better risk management. The kind of risk assessment that we do, the risk coverage that we do, risk assurance that we provide to the management is better. Better assurance, obviously, it gets covered with the first point. The better quality of data analysis, the better the quality of assurance. Since the outliers will be looked into far more detail, it definitely gives better assurance to the auditor as well as to the management that things are working fine. Enhance efficiency, you focus on select transactions, you focus on the right areas, better efficiency. Same work which probably may take 50 hours, probably you can do it in less than half the time or maybe even less. Clearer reporting. With all this focus on clear focus on outliers, the entire focus on only digging deeper into risk areas where we know probably there are indications of some exceptions, the better the quality of assurance, the better the quality of reporting. Of course, I'm not talking about the manner in which the issues are drafted, but it is the manner of basically identifying where exactly the issues are, which helps us report those matters very clearly in the report without having 10 issues where end of the day we say, okay, I'm dropping a couple of these because these are not very important. You can have that risk assessment done between high, medium, low, the way auditors do very clearly. Data analysis will help us do that. Improved audit quality. Like I mentioned, this comes from better risk management. it helps you better scoping, it helps you better field work, you know where to focus, improves efficiency, also improves the overall quality of audit that you do. You don't have to look into everything, you focus on areas where it needs more focus. Moving on, I have already covered in brief. Data analysis for internal auditors helps us in all the three stages: planning, scoping, testing, as well as reporting. At each stage, there are unique advantages of looking at data analysis, identifying which areas you want to get into. So for example, if I were to do claims, like I mentioned, I do twice a year. Probably second time when I do, I know basis my last time's experience, I don't have to kind of dig deeper into some of the areas. Say for example, because I've last couple of audits, I've seen that those areas are functioning well. Maybe in the subsequent audit, I will probably focus less on those areas. My sampling would be probably quite less on those areas. That's an example with scoping. Testing, like I mentioned, I focus completely on outliers. Once I have the entire data analysis, I identify what are the outliers. I only focus on outliers. That's the part where this data analysis helps during testing. Reporting, again, once you have found the outliers, during reporting stage, it helps us again give a perspective from the overall population perspective, applying the lens of the risk. So for example, if you are looking at regulatory risk, of course, there will be some sort of framework around how regulatory risks have to be evaluated. Of course, even when I say regulatory, it's not that one outlier or two outliers or a few outliers, unless it is going to have a major impact in terms of, say, a financial risk or a regulatory reporting risk, you may not want to rate it as high. So when I say applying data analysis, it also from a reporting stage, it applies to all the different kinds of risks that we look at, be it operational, financial, regulatory, or IT risk as well. You look at the total population and you see this set of exceptions that you have found out vis-a-vis that total population, how impactful it is. Again, I would like to clarify that even though the monetarily or from a regulatory perspective, the overall impact may still be low, there could be other reasons which the auditor will use judiciously to classify such kind of risk, and he may still classify it as high risk. So it all depends on the auditor's judgment. But risk assessment and doing data analysis helps us have that perspective in place. Okay, so with this, I've finished the second session. We are now moving on to the third and the final session. There are a few case studies which I'll be covering on claims, underwriting, and a few other areas. Let me first begin with a simple example of internal audit, because that is something that all of us are a part of, and I'm pretty sure some or the other way, we do perform data analysis in our own work, which is non-audit related. This is purely with respect to our audit plan that we prepare for the year. Something that I feel, all our CAEs should be able to relate, all the participants who are there in the forum should be able to relate to. So what is it that we are talking about? When we look at an audit plan for a financial year, there are certain audit areas which we know basis our risk assessment we have to cover during the audit, during a financial year. Some of these areas are process-based audits, some are regulatory. So regulatory audits are mandated by the regulator. Putting all these things together, you know that there are 20, 25, 30, depending on the size of your company, there are certain audits that you have to do. How do you plan for these audits? There are various factors that you incorporate when you plan for these audits. To begin with, first important variable for us to consider is number of audits that we have during the financial year. In our case, like for example, I have approximately 30 audits. Now, what is important is how am I going to execute these 30 audits? So the first important point for me is to consider is how many number of staff members do I have? Why is it important? Because there are there's a limitation on number of audits that a staff member, staff member can do, which means I probably will have to depend a little bit on external resources. That's where this variable is very important. Third, again, very important, depending on the number of staff members that we have, what is their availability? Very important to see that, there are 365 days in a year, reducing all the holidays and all, what is the man days that we have for each resource. That gives us a total man days for the internal audit team. Now, the number of audits that we do have to consider on an average, what is the number of hours or number of man days that we take to finish these audits. That multiplied by the number of audits that you have gives you the total number of man days that are required. You mix and match with in-house audit team members and where you have to apply, where you have to use services of the external service providers. Put together, you have to ensure that when you are planning for this work, the number of man hours that are available matches the number of audit man hours that are required to achieve the target of the annual audit calendar. That's nothing in a way data analysis. You get into the details of man hours, how many audits, how many number of man hours each audit takes. That gives a total hours. Basis that total hours we plan. So basically, this is nothing but prescriptive, and basis that you take other decisions to see whether the decisions that we have taken are correct or not. You make certain assumptions, and then you get into predictive and prescriptive type of analysis. Of course, there is some element of surprise that comes in our audit from time to time. Sometimes management gives us some additional audits that they want us to cover. There are times where once in a while the audit committee mandates us to do, so we adjust. So again, we go back to our desk, look at the planning that we have done, and see what are the number of man hours that we need, and accordingly we plan the dependency on either internal resources or if you want to have an external resource. Nothing but analysis of our past, number of hours that we have taken to finish the audits, number of hours that we have. So this is nothing but in a way analyzing the data that we have, our historic experience that we have, and applying that to future. So basically this helps us plan our audits better. So that's an example with, that's one case study on internal audit. Moving on, I've given some examples on claims, but that was very limited to a few areas. But here I'll try and cover a few more risk types, and we'll discuss more. I'll give more examples on each of these risk types in terms of what we do to cover that. Link it with the data analysis that we do to show how data analysis helps us identify these in a much better, efficient, and faster way. So some of the common types of risk when we talk about claims, and these are indicatives of risk. This is not a comprehensive list of all the risks. So some of these I've taken because these are very important when we are talking about, because of the considering the impact it has. Point one, claims paid in excess of admissible amount. So we all know, customers buy policies which have a particular limit of sum assured. Within sum assured also, I'm sure you must be knowing that there are further limits into room rent, ambulance charges, consumable, and so on and so forth. So that is point number one I'm talking about. Another point within that is copay. So in some products, for certain types of age bands like senior citizens, there's some element of copay. That's a product feature. Basically, copay means that if and when the claim arises, there's some amount of claim will have to be borne by the insured only. Remaining part will be paid by the insurance company. That's how the products are designed. Second risk, non-adherence to delegation of authority. Within the claims teams, there are people at different levels. Each such person within that level has a limit of up to a particular amount. Within that, they can approve or reject a claim. So somebody at an entry level, for example, may have a limit of 2 lakhs, 3 lakhs, 5, 10, more than 10, 20, so on and so forth. There are certain cases like ex gratia, which are made out of exceptions, where the approvals also have to be taken from a claims committee, where there are members from other departments also, including our CEO. Third risk, cashless reimbursement cases for same case. Often there are times where some types of customers do file cases, they initially claim under the cashless and later on also file reimbursement cases for the same thing. Investigations not carried out. Investigations, I covered a little bit in brief about these little while ago on early claims, but investigations are not just triggered for early claims. Investigations can also be triggered for other cases where the claims team feel the need to carry out an investigation depending on their past experience of frauds and other risks that they have seen. Claims paid for blacklisted customers, where we have seen instances of fraud in the past. Mismatch in the policy status between two systems. This, though unique, could be there whenever there are two different systems involved. One would be a policy admin system. One is a different claims management system. This is in our example, but I'm pretty sure for other companies also, there could be different systems being used for different types of processes. Point that I'm trying to make over here is that an analysis between these two systems on the same set of data could indicate surprises. Last is the claim paid for PD cases with waiting period. This is something that I had covered earlier. Now, I'll take you through each of these cases and try and highlight in terms of data analysis when we are doing audit. What do we check? So amount paid is higher than admissible amount. So basically, typically we see that customers, although their policy would be 2 lakhs, 3 lakhs or 5 lakhs of sum assured, but if they have spent more than 2 lakhs, 3 lakhs or 5 lakhs, Usually they never claim 2, 3 or 5, they claim the entire amount because they expect the company to have control within their systems wherein subject to the maximum sum assured, the claim will anyway be rejected, which is the case. So what happens is when claims are being filed, the intimations are being given, there are times where customers file the entire amount that they've spent. So if the claim is, the sum assured is of 2 lakhs and customer has spent 2.5 lakhs, they still claim 2.5 lakhs. So from an insurance company's perspective, we have this information stored into different columns. One which is one which says claimed amount, another which is sum assured, third which is allowable amount. Now, allowable is basically the filtration that the function does, the claims team does, basis their analysis of what is allowable, what can be paid, what has to be rejected. Careful analysis between these three may indicate some sort of system weaknesses, some sort of process weaknesses from time to time, where probably something that should not have been allowed, something that should have been deducted. To give you an example, there would be some overlaps here. Something like, for example, if there is supposed to be a copay, but something that should have been deducted but was not deducted. Some sort of disallowable expenses which should have been disallowed were not disallowed. Effectively means that something more was paid than what should have been paid. This sort of analysis will help you identify those cases very clearly. So once you do, you identify, if there are any anomalies between these three columns, it helps you focus. Second example, non-adherence to DOA. Like I mentioned earlier, different people have different limits. Look at the data, look at those limits from the delegation of authority, which is always documented and approved. Look at the delegation of authority and looking at the data, you will identify if there are exceptions. You may find exceptions, especially in times when people are traveling. So especially it happens in case of higher sum assured, although there are appropriate controls in place. Often you will find issues when it comes to documentation. To give you an example, there are higher sum assured cases where, like I mentioned, approval of CEO also is required. Now, as we know, CEO a lot of time travels. As per the process, each of these cases have to be actually approved in the system. But these kind of system accesses are never given to CEO because usually CEO is traveling. You can't expect him to log into system, go and approve. What happens effectively is these kind of approvals are probably taken these cases, first of all, are very rare, and these cases approval are taken offline. These kind of analysis will help you see whether these approvals are available offline or not. In this system, you might see that the CEO would have approved the case. Approval of the CEO and any other approving authority will definitely be available as an attachment in the system. But analysis will help you identify these cases instead of randomly looking for cases. Moving on to the third case, cashless and reimbursement done for the same case. There could be exceptions. Once in a while, there are cases where customers who have already claimed as a cashless case also somehow finds a way as reimbursement. These are often caught as a part of normal process, as a part of red flag into the system, because there is a dedupe check on policy numbers which happen. So while the customer will definitely, in these cases, customers, if they come up with an intention to defraud, they are smart enough to ensure that they don't file these cases immediately. They file after some time. But our basic policy check actually happens on the policy number where these kind of cases can get tracked. Also, it is also likely that the customer may have multiple policies. Cashless may have come in one case and the reimbursement may come under some other case. These kind of cases will help you also look at from the perspective when you look at customer, rather than only looking at the policy number. Looking at the data, you can also further look at the client ID, where you may find out if the same client had another case of claim during the same year, maybe from another policy. It may not necessarily be a case of fraud or a leakage, but it is an indication that we need to dig deeper. Fourth case, investigations not triggered. For any insurance company, there is always a framework of fraud. Basis their past experiences, we build up our checks. There are certain cases where the claims team may want to have an internal dedupe or a double check before processing the payment. There are certain cases where the teams may want to have an external investigation being done on those cases to have a better assurance on these cases. This framework is clearly laid out. Of course, in addition to cases which may not necessarily trigger an investigations, claims team is still free to carry out investigations because they have their own reasons. Looking at data, looking at cases which have automatically triggered an investigation and cases which have not triggered an investigation, but investigation has still been carried out, helps us look at whether the framework is working properly in case of the auto trigger of the investigations, and B, looking at cases where there is a specific trigger of an investigation, to check basically there is a proper logic behind triggering those. There is a proper logic of triggering those investigations. This basically is important from the perspective of looking at cost. These investigations require a significant amount of investment in terms of money. It also not only costs money, it also takes a lot of time, because these investigations will roughly take about 25 to 30 days. So it also impacts my customer servicing in terms of settlement of claims. So it is very important to see that the investigations are not triggered randomly. Data analysis will help us identify those cases. Moving on, claims paid for other policies of blacklisted customers. In the first example, what I gave about cashless and reimbursement claim coming for the same customer, that case did not specifically cover a blacklisted customer. These are normal customers where there is no history of any fraud. Blacklisted customer means a customer has had a history of a fraud or some sort of a non-disclosure, and we have blacklisted that customer. There are often cases of a failure of dedupe. Now, this is another risk which I'm going to be talking about in slides further ahead. Basically, what I mean by dedupe is Kamlesh Khanchandani taking more than one policy from the company, and all these policies of the company being mapped under the same client code. Ideally should happen, but there are often times where, for example, there is some sort of an error which has happened in the data entry. There's some sort of error which has happened in case of a dedupe. There is some change in details that I have shared this time. To give you an example, Kamlesh Khanchandani with a particular date of birth, say 1st of December, erroneously in the second policy, the advisor in the hurry has put 12th of January. Now, systems that carry out these dedupes basis certain fields where the data has to match. Now, if there are certain mismatches, these will trigger some sort of a manual review. But considering that this is a manual activity, there are always a chance of failures. So these kind of situations result into lack of failure of dedupe, and as a result, Kamlesh Khanchandani may have two different policies. Now, if in the past there has been an instance of a non-disclosure by this customer, and the company is identified, company will definitely blacklist Kamlesh from the database and will ensure that going forward policies are carefully scrutinized or probably not sold to Kamlesh because there has been a history of frauds. However, since there is no dedupe, there is a possibility that Kamlesh Khanchandani still has an active policy with the same company, which may have been remained unnoticed because the blacklisting has happened for that policy, for that customer, that client ID, which only listed one policy at that particular point in time. Doing a data analysis on customer names and auditors ignoring the client ID not matching, because we know the client ID has not matched, but looking at other data fields. To give you an example, reading the address. So for example, if you read the address and you see that Kamlesh, this also stays in Andheri East, this also stays in Andheri East, name of the building is also matching, pin code is also matching, probably mobile number is also matching. There is some sort of address proof, some KYC document, which is also matching, which means it's a clear failure on the first leg of transaction that the dedupe has failed, which means this is a clear case that this particular policy also should have been considered for further investigation and blacklisting if required. Not suggesting that blacklisting should happen, but it is an exception which data analysis will clearly help us identify. Next point, claim settled for inactive terminated policies. As I mentioned before, there are times where we are using multiple systems. Multiple systems do from time to time have issues. There are no systems I have come across in my career of 23 years where two different systems always work seamlessly fine without any issues. So in our case, we have seen issues where there are some sort of mismatches between two systems. Looking at data from these two systems help you understand if there are policies which have any sort of different information from this system vis-a-vis the other system. Reason being that while that information, some of the information may be seemingly not harmful at all, there could be some information which could be very impactful when it comes to claim. Example being, for example, if I at the time of application, I have erroneously declared my age as less, and post that I have given as a part of policy servicing and I have corrected and said my age has changed. Now, while that age may have corrected in the policy admin system, but for some reason, say for some batch failure or something, this particular feedback has not gone back into the claims management system. Now, claims management system will probably or likely would show a different age. Policy admin system will show a different age. Possible that when the claim is being processed, there is a probability that the claim may get rejected for wrong disclosure saying that the age is wrong. In this case, the customer may not be wrong because customer has taken all the precaution. It is more a system integrity issue where information has not flown in correctly. What I'm trying to say by this example, I've given my example. I'm sure in your companies there will be other like systems where two systems use information from each other. Look at data from these two systems on critical fields, define that objective, perform analysis on that data, and maybe you come across some exceptions where the information is not aligned. Moving on to the last example of claims, PED, I've already covered that before. If the objective is to basically see if there are cases where customers have claimed within 30 days, as an auditor, I apply that objective and see if there are cases within 30 days to see whether there is a flag for investigation being carried out or not, and whether the investigation has actually been carried out or not. This analysis helps us see that whether the process has been complied or not. Moving on to second very important area from the insurance perspective, commission, rewards, incentives. Very important, very significant cost for insurance companies. Significant cost also comes with a significant risk there. Also, huge variable in terms of churning of people, as you must be aware, advisors, third party. There's a lot of churning there. So this comes with its own unique risks. Some of the key risks that I've highlighted over here is incorrect commission, rewards, incentive payments, payments made to related parties, unusual number of policy cancellations, customer complaints against advisors, unadjusted, unrecovered amounts for advisors. These are some of the key risks that I've highlighted. There are more. We'll dig deeper into each of that and I'll relate it to how data analysis will help you identify incorrect payments. One such example with my business is group business, where the rate of commission maximum ceiling has been defined by IRDA, but the actual commission that gets negotiated would always vary on a case-to-case basis. As you must be knowing, group business is highly competitive. What I'm talking about is, say, an employee-employer policy. We all must be having, we're working in corporate, so we have our group cover. And there is always a broker which is involved in these kind of businesses. Now, the brokerage which gets paid to this particular broker is never same for two clients. It all varies depending on what are the other quotations, what are the competitors doing. And this commission is extremely flexible from 0% to, it can go to as high as 7.5%, 15% depending on case to case. 7.5% in these cases. Now, as an auditor, the first thing that we can look at when we are looking at this is performing an analysis and bucketing these cases into different rates of commission. So if you find somebody coming between 0 to 5, mark it separately 5 to 7.5, 5 to 7 or 7.5. That way you do bucketing. Within that bucketing, you look at examples to see whether there is a proper approved documentation, there is an approval for each of these commission rates that you are seeing. Why this is important? Because group products, like I said before, group products are extremely competitive. Pricing, which also includes a factor of commission, is very important. So a little bit of change in commission from, say, 2% to 3% can make a big difference when it comes to the total price of the product. So for an auditor, and this is huge volume, it's not that in a year a company would do only 1 or 2 or 10 or 20 or 100 employee-employer schemes. There are these business runs into hundreds and thousands of employee-employer schemes. So this analysis will help us focus more. Payments made to related party. One such example I had given is basically you have an advisor. There are times where you may come across cases where there are more than advisors with the same bank account number. Why this happens? It could happen because of related party. For example, in insurance parlance, it happens when a husband and a wife both are working for the same insurance company as an advisor, and husband chooses in this kind of work, possibly it is the husband who is doing the work and wife is just signing the papers. This is very common in the insurance industry. What is not allowed is that the husband gives the bank account number, in this case, against the advisor code, which is mapped to his wife. So these are the kind of things that will help you see when you do a data analysis or data matching between two different data sets to see if there are same bank account numbers appearing against multiple advisor codes. Unusual number of policy cancellations. This is very important from the incentive and rewards. From a commission perspective, not very impactful because at a commission level, these kind of cases are handled. There are enough automated systems where policy reversals automatically, policy cancellations automatically result into commission reversals. And these commissions in the subsequent cycles, in some companies I've seen where the commission itself is paid after the free look period, where there, beyond which there is very less probability of a policy cancellation. So there is no requirement of a commission reversal in the first place. Those controls are automatically built into the systems. But still, there are companies where for certain channels, you may do something like that, where commissions are processed at a higher frequency without waiting for the free look cycle to happen. Of course, there are cases, exception cases where customers may come after the free look period also, where companies on case to case may process the free looks, which will result into policy cancellation, which should trigger the commission reversal. So looking at the volume of those, further digging into if there are some sort of trend analysis, like for example, is there a focus on certain advisors, certain channels, certain partners, certain branches, will help us focus more on those rather than randomly looking at random samples where probability of we finding anything at a design level or a poor effectiveness level at a transaction level is very less. Analysis will help us focus on the clear outliers where we should focus. Last point, fourth point, basically customer complaints against advisors. These are two unrelated areas. Commission processing team will never look at any complaints which have come against advisors. But as an auditor, looking at complaints against advisors and trying to understand the kind of businesses that advisor has done will probably help us give some sort of insight into whether there is anything wrong going on, and if there is anything gone wrong, whether the corrective action as a part of process design has already been taken or not, or there is some exception still lying outside which has not been corrected, which we should handle. That help us focus on that. Moving on to the next point, unrecovered negative balances. This is basically cases where there are cases where the recovery has not happened for whatever reason. What is happening on those? Aging analysis of these kind of balances will help us focus to see whether there are any unaddressed design issues within commission and whether there is enough management control and in the form of monitoring these outliers and whether proper action has been taken on. Manish, I am looking at time and it's already 8 and I have a few, at least good 6-7 slides more. So I just wanted to know from you whether it is okay to continue or I'm fine, I can stop over here because it will take another 15-20 minutes, 10 minutes at least.
Okay. I leave it to the participants. I would be more than happy to, hear you, share your thoughts. So if the participants can just let me know whether they are agreeable to an extension of around 15 minutes in the chat, I could then accordingly modulate the whole thing. Okay. Kamlesh, what we could do is maybe you can give a quick overview of it. I think your presentation has been quite intensive. Maybe you can just very quickly give an overview over the next 5 minutes or so.
Yeah.
Maybe cover the main points that you have collated, because it would be.
I'll do that. Yeah, it's better to at least, kind of give a top view on what I've covered.
Yeah.
Okay, so I'll move on to the next slide. Accounts payable, this is very generic. We all know. Looking at the data from a master data perspective, if any changes have been done, gives a good insight. Duplicate invoicing, payments, users who have access to supplier data, and also looking at if there are any possible segregation of duty conflicts within the area of work that they are doing. Looking at the master file and the kind of transactions that we have done, focusing on very active suppliers, non-active suppliers, suppliers which have been enrolled, which have been kind of recorded in our systems, but without any transactions. Looking into those will help if there's something to identify if there's something wrong happening there. Common bank accounts, not just between suppliers, but also between suppliers and employees. This takes me back to the privacy related point that I had mentioned. As long as the privacy concerns are addressed, this will be a very important point to see if there are any advisors, if there are any employees, or even advisors for that matter, who are a part of our supplier network. Next point is invoices with no corresponding purchase order, unapproved purchase orders, multiple invoices, or just, where people kind of break down invoices to avoid the delegation of authority. This is more with the contact center. We all use contact centers. So looking at incorrect billing of hours, all of this data, when it comes from contact centers, there is no dearth of information. In fact, I'll put one slide. I'll just show that I have. Yeah. So this is a slide which it's an example of the kind of data that we have. So it basically runs into hundreds of columns, starting from what time they have logged in to what time they have gone. Looking at this data, it will give us a lot of insights into wrong billing. Looking at this data, we can also look at if there are any penalties which should have been levied for unproductive hours, whether we have levied that or not. Employed agents in contact centers versus their bill agents count. Are there the agents that they are listed in their bill, whether they are actually their employees or not? You should also look at that, because in the past, we have come across cases where they billed for certain employees which were not a part of their company. They already resigned and left, but they were still billing us. Billing of idle hours, extended, more than average time being taken. So it helps us also look at whether the productivity is as per expectation or not. System downtime. This can also be linked to our systems. More often than not, contact centers also use our systems. Their reporting of system downtime can also indicate probability of some system downtime at our end. Information security. Basically, you look at what information get exchanged with the contact center. A lot of times I've seen information being exchanged over emails, SFTP, a lot of redundant information being shared, which is actually of no consequence to the contact center from the role perspective, the job that they're performing. Okay. Moving on to underwriting, again, quick, multiple client IDs I've covered. Multiple client ID poses a significant risk at various stages, including underwriting. System configurations, basically, what is the kind of underwriting you want to do vis-a-vis how the system has been configured. Looking at data will help us look at if there are any exceptions to it, whether the underwriting the way it was supposed to happen, whether it happened or not. Policy issuance and rejection tax. Underwriting departments have tax within which they have to process. Looking at data will help you understand whether that has happened or not. Additional risk premium. So if you come across cases where customers have some sort of a high risk profile, high age bracket, some sort of PED, there is a possibility of additional risk. Looking at data, you can identify whether that additional risk premium has been charged or not. Inadequate control over medicals. Basically, certain types of medicals should have been triggered, whether those medicals have been conducted or not. Acceptance from blacklisted areas. This is part of the risk framework where underwriting department also identifies that there are certain high risk clients, high risk areas. There is some sort of a red flag. Looking at the MIS, you can identify, dig deeper to see if those red flags have triggered or not, and whether against each of that red flag, whether proper additional enhanced due diligence has been carried on. Policy servicing, it's very generic, whether the customer request has been addressed or not, whether there are any delays. Incorrect closure leading to follow-up. So for example, in the system I've triggered, I've said that the customer complaint or a request has been addressed. However, in effect, it has not been addressed. There are repeat complaints. So looking at repeat complaints from data will give us insights into whether things are working fine or not. Client dedupe, like I mentioned, client dedupe is a major risk for any insurance company. Customer requesting for say an address change in one of the policies, if the client dedupe, client merging has not happened, all the policies are not appearing under the same client ID, there is a chance that your address may get changed in one policy and not get reflected in the other. And this can have repercussions. That's it.
Okay,
Any
wonderful.
questions?
I think, Kamlesh, that was quite an interesting session. And I think you've taken us on a journey of how to approach the entire subject of data analytics, and those practical examples that you have covered. I'm sure that you could have shared a lot more on the other slides which we have taken over. But I think it was a very interesting and engaging conversation that we have had. If there are any questions from the participants, we could take them, a couple of them. Okay. I think, Kamlesh, thank you very much for taking us through your thoughts today on the subject of data analytics. And believe me, the kind of examples which you have shared and going to be a very good reference point for auditors as we move ahead. Because the limitation that we have seen in organizations adopting technology or adopting data analytics is in visualization. Where do I apply? How do I apply? You know, where should I start? What kind of data limitations are there? And the mindset, the basic mindset of use of data analytics and how exactly we can go on that journey from, looking at historical data, coming out with those exceptions and supporting business into what went wrong. Moving on to a phase where we are doing it more real time. We are doing repetitive analytics and we are supporting business in coming out with the exceptions nearer the event so that a large part of it can be prevented. And then moving on to, machine learning and so on and so forth. So I think the starting point for the journey very rightly is a mindset, which you talked about in your initial few slides. And thank you for an excellent presentation and share. It was really wonderful, and hope to hear you again and see you again sometime soon. Thank you very much, Kamlesh. Thank you everyone for joining us for the session today, and looking forward to your active participation in the future too. Thank you very much. Thank you.